Good morning, everybody, and welcome to this month's IFRS and Corporate Reporting webinar. Now, this webinar is one of the key webinars in our series of webinars at BDO because it is our accounting standards update, getting ready for 30 June 2023. We do a similar webinar to get ready for 31 December every year, but as we all know, most entities in Australia have a 30 June year end, and therefore this is a really important webinar. As always, I'm joined by Kevin Frobus, our IFRS and corporate reporting partner in Sydney. So Kevin, lovely to see you, even if it's just online.
Hi, Aletta. Well, actually, we should probably update the regular followers on this webinar. We have seen each other since the last webinar. We have had our National IFRS and Corporate Reporting and Sustainability Reporting Conference down in the Mornington Peninsula. It was lovely to see you, Aletta, and it went well.
Yes,
Nice
fantastic.
to see everybody today, and let's get going.
Yes, fantastic to have everybody here. Just a reminder maybe up front that this is the one webinar due to its popularity and its importance on the calendar. We always schedule it for 90 minutes and not 60 minutes because we want to, set the expectation that this is not just a 60-minute webinar. So it would have been scheduled for 90 minutes. I'll throw Kevin under the bus. He forgot about the 90 minutes and until I reminded him yesterday. So if any of you forgotten, our presenter also forgot about that. Then I would like to begin by acknowledging the traditional owners of the land on which we meet today. So for me here in Melbourne, it's the Wurundjeri people. And we pay respects to elders past, present and emerging. And we extend that respect to Aboriginal and Torres Strait Islander peoples here today. So if we look at the agenda for today, quite a number of items. Kevin and I have tried to order them so that what we think is the most important we go first, or maybe the items that we would like to discuss we put first. So the hot topics in the profession, then an ASIC update, and then sustainability reporting, and then followed by changes to IAS 1, in particular the classification of liabilities between current and non-current. So I know a lot of entities, especially in current times, would be looking at their balance sheet, the strength of their balance sheet, and a number of critical ratios when they speak to their banks. So that classification in IAS 1 is important. Then we go on to standards applicable for the first time in 30 June full years and half years. We look at standards that are issued not yet effective, and we recap some other important information. However, we won't discuss it at length. Recent IFRIC agenda decisions, some changes for listeds, for AFS licensees transitioning from special purpose to general purpose, how to access corporate bond rates, and an update around hyperinflationary economies. So a lot of the items on the right-hand side of the screen, we've got comprehensive slides. We'll see if we can get to them and address them, but it might be a little bit of homework for you as well. We would also like to invite you to our upcoming not-for-profit webinar. So you'll see today there's no specific focus on not-for-profit entities. Everything in this webinar applies to not-for-profits as well. However, for not-for-profits, there's very specific developments. Looking at them, potential development of a third tier, etc. And we'll be looking at all of those matters in a separate webinar on the 7th of June. It's not just an accounting webinar. We'll also be joined by some other partners from other parts of the business and discussing matters that are definitely on the agenda and being discussed with boards and finance teams at the moment. So hot topics in the profession. Kevin, and this is where I'll hand over to you.
Thank you, Aletta. And we will get into it. As Aletta said, we're going to focus and spend some time in the outset on these sort of upfront topics and spend some time around them. And so we thought we'd just start with the hot topics. And when we started to put the hot topics together, the list almost looked like a list of all accounting standards in the world. But pulling it back, the reason for that is that currently the big news stories of the world are inflation and interest rate increases, and those have very specific impacts on accounting. They have impacts on the measurements of assets and liabilities, and that pulls through really a comprehensive list of the most important standards on the screen now, being things like impairment, fair value of financial assets and liabilities, investment property and biological assets, leases and so forth, long service leave. All of them are there. Shall we call it the greatest hits are on screen? But I actually want to just talk a little bit higher level about what's really going on here. And in terms of hot topics in the profession, it's probably a discussion about how you should approach your 30 June year end. Really, the corporate reporting or the financial reporting life cycle has become just that. It's a life cycle. It's no longer the sort of thing where you kind of address individual standards on an ad hoc basis. It really is about actually holistically approaching financial reporting by planning, understanding the impact across the board and the business, setting up consistency of inputs and measurement bases that the whole organization can respond to, aligning that with the accounting standard requirements, and then going on to execute. And I think the best way to explain that is really to talk about interest rates. So if we have a look at this, and I'm just going to take 4 of these standards on the slides now. So impairment of assets, leases, long service leave liability, and let's take provisions, those 4, and for example, restoration provisions. All of those standards, for example, are impacted by interest rates in very different ways. If we take impairment of assets, most organizations who do a discounted cash flow value in use model will use some sort of discount rate that is either based on weighted average cost of capital or some variation of that. But when you get to leasing, for example, you're working with incremental borrowing rate, a very different rate, even though it's impacted by the same thing, which is interest rates and inflation down below. And the same thing with the long service leave provision, which you'll see later on, is driven by corporate bond rates in the for-profit sector, and then provisioning, which is a whole other different set of discount rates used for things like restoration provisions. The point I'm making here is that IFRS and corporate reporting has become, while you weren't looking, quite sophisticated in its approach. These are all very different conceptual types of interest rates. They're all sensitive to change in the market. They're all sensitive to changes by environment. For example, different foreign operations in different countries will have different interest rates. And so these things have an impact, and they've become material, especially in the last year. I want to say that we've probably got a generation of financial controllers and university students who've gone into the profession, during the era of low interest rates, that have never seen the application of accounting standards in a high interest rate environment. And we're there now. Aletta, you and I, we've been here before. I think we probably both remember something closer to the 17 and the 20%. So that's how old we are. We're all geriatrics when it comes to this. But it really is now a new ball game up to 30 June 2023, especially because of, as I say, interest rates and inflation. So my message here is, really, before diving into 30 June 2023, it may be worth taking, especially the standards on the screen, and understanding the impact of interest rates on these standards, and then essentially formulating a plan of attack. How are you going to actually, first of all, gather your inputs, the sources of information that are going to impact these things? Who's going to do it? How does that align to business plans and business objectives? How do you calibrate that in the various economic environments? And then how do you align that to the requirements of the different accounting standards? One rate does not rule them all, yeah. One rate does not rule them all. A reference to Lord of the Rings. There's a lot going on here, and you need to kind of embed that in the organization before you actually start to do the measurement and hire your valuers and so forth. We've got an article at the bottom there you can take yourself to, which is 6 recent interest rate increases for your 31 December 22 financial years. Now that was perhaps 6 months ago, but the same concepts are relevant. So the article is still relevant. I'll leave it at that. Jumping forward to the next slide then, on a couple of things we've noticed which you might want to just be aware of. Things we've seen which perhaps maybe weren't so much of an impact in the past in a low interest rate environment in provisioning. We've noticed that in terms of provision calculations, and this might be for restoration provisions over a long period of time. Some entities use real cash flows and real discount rates to calculate these provisions as opposed to nominal. But the idea of this one is, well, which one's right? Probably neither, because depending on how you apply it, you actually do get back to the same answer, especially on the measurement of the provision. But unwinding those discount rates can have a real strange answer in your interest rate expense line. And the question that came up, or that bubbled up to the surface at some point, was, should borrowing costs resulting from the unwinding of discounts and provisions to reflect the passage of time be lower if you're using real discount rates? And the answer is no. The answer is there'll be a second adjustment somewhere along the line, depending on how you do this, that essentially counters the re-estimation of the provision amount, and that amount should be included along with the unwinding of the discounting in the borrowing rate. So really, whether you're using real discounts or nominal discounting rates and cash flows in your measurements, if you execute this correctly and include the right numbers together, your borrowing costs should be the same in terms of your presentation and disclosure. Now, if that doesn't quite ring true and you're not quite sure what I'm talking about there, it might just be part of your approach to 30 June is to kind of go stand back and say, well, what am I using here? Am I using real? Am I using nominal? What's the source of my discount rates? Am I actually tying up the cash flows correctly? Because if you need to be consistent in the cash flows and the discount rates when you do these, but really you shouldn't be coming to any difference when it comes to presenting the borrowing costs, because as I said, unwinding and re-estimating the provision amounts will give you the same answer whether you're using real or nominal. Just make sure you're picking that up. Jumping then forward to the IBRs, which is on our next slide, and I made mention of this before. This is, I have to tell you, Aletta, I had to wrestle this slide away from Aletta. Her favorite thing in the world is leasing, and she wanted to do this, and I said, no, it's going to disrupt the flow of the presentation. Bearing in mind with interest rate increases, the discount rates for lease accounting will be changing. Now, the leasing standard is quite a sophisticated standard. It is a process-driven standard that actually is also conceptually aligned to the pricing of leasing. What that basically means is for new leases, modifications to leases, or option period reassessments, those are the three things that drive using a new incremental borrowing rate in your lease calculation. So if you've had leases or changes in your lease portfolio in the current period or up to 30 June 23, and you have a new lease, or you've modified an existing lease, or you've reassessed the exercise of an option period which changes your lease term, you're going to have a new incremental borrowing rate used for your discount rate. That means you need to go and source a new incremental borrowing rate for that calculation. Now, 2 or 3 years ago when the leasing standard came out, might have even been 4 years ago, I can't recall now, interest rates were quite low, and so we found that lots of organizations were using incremental borrowing rates that were quite low, 1, 2, maybe 3%, and it almost didn't matter if you weren't quite precise in that number because it didn't really have that much of a material impact. That's not the case anymore. So you might have a lease that you had for a while on the books, which you now have either modified, or maybe you've got an option reassessment, or like I say, you've entered into a new lease that you didn't have before, and suddenly you're going to find that you need a new IBR, which is holistically different to what you were using 2 or 3 years ago. You know, we're seeing rates 7 and 9% in some cases, depending on the type of lease and what you're talking about. We have noticed that a lot of audit firms are requesting that those IBRs be actually calculated by a professional valuer in some cases to get the precision right, and that is because the base rates and the credit spreads have changed quite significantly, and the precision of that calculation is actually having quite a material impact now on your leases. This comes back to what I said at the beginning about get prepared for 30 June 23. Treat this as a control cycle. Treat this as a life cycle where you actually have to prepare, get your valuers in line, understand what the impacts are, and essentially develop an approach to deal with this stuff rather than waiting for it to come at you during the audit cycle, which then, you know, things go off the wagon. And obviously, if you have lots of new leases, lots of modifications, lots of reassessments, you know, you're going to have, you might need multiple number of discount rates because it is a per lease assessment if you aren't applying portfolio approach accounting. I think I'll leave it at that. I want to say, Aletta, do you want to add anything? I know that you probably no. All right, we'll take it at that. Accounting.
I want to add a comment about your geriatric comment, because
sure,
you know I'm quite offended by it. But anyway, so I'm commenting on something different. I think those high interest rates, we also maybe due to our accents, we saw that in South Africa, right? 17 to 20% interest rates in South Africa. That's when we bought our first house. But other than that, I just generally object to being called geriatric, but otherwise,
I'll say that I was actually referring to myself there, and I just needed some company, so I'm happy to go it alone. All right, let's talk about accounting in times of uncertainty. Won't spend a lot of time on this one. It has been around for some time. You'll see that our global publication at the VDR level was issued in 2022, so it's not a new concept. But it comes back to the same concept I was referring to before. You know, there's lots going on out there. The war of Ukraine, which seems to just keep going. Energy prices, which I'm not sure if they're rising anymore or stabilizing. It depends who you talk to and who you're using. Supply shortages and inflation, these things are all sort of feeding into business risks and business uncertainty, which should be feeding into your cash flow assessments, your going concern assessments, your solvency and liquidity assessments, and so forth. I think my comment here would be, if you're going to start looking at things like going concerns and budgeting assessments, or budget and cash flow assessments, which feed into impairment assessments, which feed into discount rates, which feed into business decisions that impact subsequent event assessments, all of these things are having an impact. Taking last year's budget and rolling it forward and adding a 3% increase onto it isn't enough. That's probably what my message is here. These assessments and these considerations are a little bit more sophisticated, they're a bit more nuanced, and also the range of possibilities have increased. So, you know, more and more we're seeing things where there are a range of possibilities that are increasing. The high and low are getting quite far apart from each other, especially when you come into valuation of assets. So it's a matter of getting organized, understanding and assessing these things, stress testing your assumptions before building your models, and essentially having a plan before you dive in. I think I'll leave it at that and say, Aletta, over to you for the ASIC update.
Thank you very much, Kevin. I think that was a really good explanation of the interdependency and the way all of these issues are all linked, really. So thank you for that. If we look at the ASIC update, the first one I think is old news, but just a reminder that those large grandfathered private companies no longer have the exemption. So they have now lodgement exemption. So they now have to lodge audited financial statements with ASIC within 4 months of reporting date. So this already came through on the 4th of August 2022, but just another reminder that if you've got a 30 June year end, you're a large grandfathered PTY Limited, you know, the change is now very real for you. And you'll see throughout our presentation, we've got a number of links to articles if you want to explore it a bit further. When we look at the ASIC focus areas for 31 December 2022, they've not yet issued their focus areas for 30 June 2023, but often it's very similar, maybe a few small adjustments, maybe here and there a new item. They have 5 key categories of focus. The one is around asset values, and that really ties back to what Kevin have just discussed around uncertainty, around inflation, around interest rates, and what that does to asset values across a range of issues, whether it's impairment of assets, whether it's values of assets, whether it's ECL of receivables and loans, you know, asset values is a focus, specifically around the current economic climate. Provisions is another one. So again, the adequacy of provisions around onerous contracts. I mean, if you look at supply chain issues, we could be in a situation, and a lot of the construction industry, will potentially have onerous contracts where input costs have increased, but they are locked into fixed contracts. So look out for onerous contracts. Financial guarantees that's been given, again, in the current economic climate, some restructuring and when it's announced, and therefore can we and should we create a provision or not, make good provisions around leases, and then also restoration costs around mines. So very specific focus around provisions, not only whether you use the real or nominal discount rate, but actually the extent of identification of potential provisions. The third area is around solvency and going concern assessments. Now, again, need I say anything more? We're sitting in a current economic environment where there's a lot of pressure on companies, there's restructuring, there's cost cutting, and a focus on solvency and going concern. Subsequent events, important to consider subsequent events, of course. And then the last one, disclosure in the financial report, and in particular, the operating and financial review, the OFR. This has been a focus area of ASIC for a while. And as I'll show in the next slide, there's been a number of additional disclosures being provided by listed entity as a result of ASIC activities. So there's a huge focus on entities providing appropriate disclosure of business risks and opportunities in an OFR. With reference to, have you considered climate-related risks and opportunities? But the focus is broader than just climate-related risks and opportunities. It's all business-related risks and opportunities. It's important to make sure that these disclosures in the financial report complement the OFR, and that all these disclosures are adequate. If you look at some ASIC enforcement media releases, now I haven't included all the ASIC enforcement media releases here. We deal with them in newsletter articles. But some of the key themes, using market capitalization for impairment testing, I'll touch on that shortly. Non-IFRS subtotals or information. Again, the lack of business risk disclosure in the OFR. And the fourth one is interesting, overstating trade receivables and deferred revenue. Because if you overstate your receivable, what are you overstating on the credit side? You're overstating the deferred revenue or the liability. Impairment write-downs, loan establishment fees, the appropriate treatment of that, contingent liabilities and provisions, still failing to lodge financial reports, and then a number of proceedings on some other matters. So ASIC has been busy, and we've seen that in the enforcement media releases. This one is very important, and we've put in a link there to the actual media release. So when entities do impairment testing, we look at comparing the recoverable amount with the carrying amount of the asset or the CGU. And we know that recoverable amount is the higher of value in use or fair value less cost of disposal. So I think everybody's still happy. However, often we've seen that if we've got an entity that have only one CGU, all right, so a single CGU entity, there has been the potential risk that entities would say, hey, hang on, if I look at market capitalization, so P times Q, price times number of shares, can we use that as a quasi-impairment test in order to indicate that this single CGU has a fair value less cost of disposal that's in excess of the carrying amount in the balance sheet, and therefore we don't have to do any further work? I think it's important to note that that approach is not appropriate. Really important to note, and it came out clear in this ASIC media release, that market capitalization in paragraph 12 of IAS 36 is an indicator of impairment. There's a number of internal and external indicators, and market capitalization is an indicator of impairment if market capitalization is below the carrying value of the assets of the entity. However, market capitalization is not a proxy for fair value less cost of disposal, which is one of the items we consider to determine recoverable amount to do an impairment test. You know, if you look at transactions in a company's shares and market capitalization and the sale of the whole business actually takes place in different markets, and there are different market participants. So if you are comparing the different aspects and looking at different market participants, you can get significantly different values, and therefore it's not appropriate as an impairment test. So if you want to use market capitalization as an indicator, or if you want to look at market capitalization for a single CGU, and you want to use it as a input or a consideration, nobody can stop you, but you still need other measures in place. You still have to calculate value in use or fair value less cost of disposal using reasonable and supportable assumptions. So it could be a consideration, but never the only consideration. And that is particularly true if we're looking at entities, single CGU, and there's significant goodwill or there's significant intangible assets in particular. So I would say that would be a higher risk category. So this is a very important ASIC enforcement media release. We've addressed it in an inside article, and there's also some information around impairment testing on our website. The other one is around the use of non-IFRS subtotals, especially in the P&L. And it's really important to note that we can look at non-IFRS subtotals, but they cannot be more prominent. So they cannot be in bold as opposed to IFRS subtotals. And again, we've got an article discussing that. In general, when we look at non-IFRS information, you know, RG 230 issued by ASIC does not permit non-IFRS information in financial statements, especially the primary financial statements. And they give us some examples. You cannot have additional subtotals in your statement of profit and loss and other comprehensive income. You cannot have additional columns in your 4 primary financial statements. You cannot have a separate section below the financial statement that are adjusting your statutory profit to something else. You can, however, present non-IFRS information in your director's report in the OFR if it is properly reconciled to the statutory amounts and in the statutory accounts. So it's really important that when you look at the primary financial statements, we have to stick to what IFRS and IAS 1 require. If you want this non-IFRS information, reconcile it and put it in your director's report or your OFR. The last one that I want to discuss at length is around the operating and financial review and the lack of business risk disclosure in the operating and financial review. Now we list here 3 media releases that's been issued recently around this matter, and you can read each of them, but they highlight that in the first one, 6 listed entities increased their material business risk disclosures as a result of some enforcement ASIC activities by ASIC. Then there is another 4 listed entities, another 5 listed entities. So the list of entities that are being approached by ASIC and then ending up making adjustments or adding additional business risk disclosures in the OFR is growing. So ASIC continues to closely review the annual reports on a risk-based approach to ensure entities are correctly disclosing material business risks. And we know one of the material business risks that they're currently looking for are entities disclosing material climate-related risks and opportunities. So that's just a number of things to look at. So, you know, why must listed entities disclose this material risk? You know, we have to talk about, it's under Section 299 capital A1 of the Corps Act. OFR must disclose information that members would reasonably require to make informed assessment of the operations, the financial position, and business strategies and prospects for future financial years. So not just risks, but also opportunities. And, you know, there are material business risks that's explicitly required. There's an RG 247 that looks at it. And, you know, ASIC has made a number of recommendations and publications over recent months around this. And we know there's activity, as we can see from these media releases. ASIC is active in this space. A number of articles for you to consider what we're seeing in practice. The next area that I'll touch on briefly is sustainability reporting, and it links with the focus in the OFR around business risks, opportunities. So we know that in December, Treasury has issued a consultation which for the first time gave a quite clear indication of what mandatory sustainability reporting could look like in Australia. Now, we are eagerly waiting for the publication of IFRS S1 and S2 by the ISSB, and we know those two publications will have a recommended effective date for years beginning on or after 1 January 2024. However, it's up to jurisdictions to consider how they implement that locally, and our Treasury has indicated that they'll follow that timeline, or currently that thinking is they'll follow that timeline. They're currently reviewing all the submissions they've received on this publication, but we don't expect a big variation from global timelines and the initial dates provided in this publication. So if we look at a timeline, expected timeline in Australia, we're looking at, if you've got a 30 June year end, mandatory compliance with IFRS S2, climate-related disclosures, in your annual report for 30 June 2025. And that will mean quite detailed disclosures around climate-related risks and opportunities, and also a disclosure of the measurement of your Scope 1 and Scope 2 emissions. Scope 3 has been delayed by a year. So by 1 July next year, you'll have to start to capture the data that you need for Scope 1 and Scope 2 emissions, and you have to do a lot of disclosures outlined in IFRS S2, which brings us back to today. For 30 June 2023, we would highly recommend that entities look at the TCFD recommendations, and highly recommend entities start to measure and disclose their Scope 1 and Scope 2 emissions as required by the TCFD recommendations. And ASIC is strongly encouraging the use of the TCFD recommendations. Now, these TCFD recommendations being pushed by the ASX, APRA, and ASIC are linking climate-related risks and opportunities with strategy, with risk management, but ultimately with the numbers in financial statements, with the values of assets, with liabilities, provisions, linking it with revenue, linking it with costs. So actually ties back beautifully with all of the things Kevin and I have been talking about already today, because all of this is linked, and it's linked with the OFR. The core elements of the TCFD recommendations are 4 pillars. You don't start with metrics and targets. You actually start with governance, then you look at strategy, then you look at risk management, and then finally you get to risk and metrics, metrics and targets. If you look at those 4 pillars, there are 11, I would call them high-level recommendations for entities to consider now. And you'll often see the word describe your governance at a board level, at a management level, describe the impact on your strategy or how you've embedded climate-related strategy in your broader strategy, how you've embedded climate-related risks and opportunities, how you identify, assess, and manage those risks and opportunities in your overall risk management. And finally, the words change a little bit when you get to metrics and targets. It's now disclose Scope 1 and Scope 2 emissions and describe your targets. It's important to note you don't have to comply with all 11 recommendations at once, and that's why we are recommending a roadmap and a stepped approach to start to look at these recommendations. Do what you can 30 June 23, do a gap analysis, at least do Scope 1 and Scope 2 emissions, do a gap analysis, think about next steps for 30 June 24, because these are good stepping stones to get to mandatory reporting 30 June 25. I just wanted to flag Scope 1, Scope 3, if appropriate, Scope 1, Scope 2, if appropriate, Scope 3 emissions is not a describe, it's a disclose. Scope 3 is usually relevant to material because it's between 80 and 90% of your carbon footprint. But we're not pushing for Scope 3 now. We're saying softly, at least start with Scope 1 and 2, learn the lessons so that you're ready for mandatory reporting and start to look at Scope 3 as well. Kevin, at this stage, I'm handing over to you to look at IAS 1. And I know this standard is not mandatory, so people might say, why the focus? It's not mandatory for 30 June 2023. But it is so relevant in the current economic climate. It is so relevant for people renegotiating loans and bank covenants at the moment. So when you renegotiate loans and bank covenants, please be aware that the disclosure will be very different going forward, and be aware of the impact that your new covenants and your new agreements, if it interacts with IAS 1, that there's a very direct link. So Kevin, over to you.
Thanks, Aletta, and I'll reiterate that it's not effective for 2023, but it is effective from next financial year. And so to kind of flow on from Aletta, you would have to, in some cases, especially for your tier 1 disclosures, you would have to disclose in 2023, this year's financials, what the impact's going to be next year. So you need to get on top of this one now, and we are going to spend a bit of time on this. You'll see there's a lot of slides in this section, and so that means that one is I'll go through a lot of the detail, but also there'll be a bit of homework. And what I encourage you to do with this section is to take this section after the fact and go work through the examples again, just to make sure you understand how we got to the answers we got to, because as you will see, there's actually some very real changes here. This is not a section that, oh, they've just kind of changed some language, but the net impact is kind of the same. That's actually not what's happening here. This is a fundamental shift. And the reason why I know it's a fundamental shift is probably the way they got to this got so heated in the standard setting process that they went through 2 rounds of amendments. Now, the 2 rounds of amendments that they went through on this one actually was an initial draft. They made some amendments, and then there was actually feedback from so many interest groups and so many parties around the world that they had to go at it again. And there was sort of 2 rounds of amendments that came through. The reason why I'm putting that on the table is because when you look at the literature out there on this, you probably need to make sure you're starting with the right amendments to begin with, because there were versions of this along the way. There were effective dates that got deferred, but ultimately they've come up with, all right, yeah, we are ready to go. Here's the amendments, and everyone, you're going to implement this from 2024. So let's have a look. I'm going to take you back to the beginning. Let's start at the beginning, and let's look at what the current requirement is for current, non-current. And I want to say that everybody on the webinar today will know what we mean by current and non-current. This is an old concept in accounting. It's been there for years. How do you present your liabilities as current, non-current? Actually, this also applies. Current assets also have a classification, and non-current assets. But what we're specifically dealing with here is the liability classifications, current and non-current. And what we have on the screen now is an extract from the standard. This is the rule as it currently exists. So this is the one we're all used to, and this is the one that we've all been using for years. Now, I'm going to jump down to part D, because the one that's exciting about current, non-current is in order to present something as current, the entity will use that one when it does not have an unconditional right to defer the settlement of the liability for at least 12 months after the reporting date or after the reporting period. Put another way is, in order to use non-current, you had to have an unconditional right to defer. Now, why we've highlighted the unconditional right is that word unconditional is the one that over time has become hard to interpret and apply. I want to almost say that in the consulting and advisory world, trying to overcome that word almost became a blood sport in terms of structuring deals and liabilities and so forth. So that is the one that they wanted to focus on, is what does it actually mean to have an unconditional right to defer settlement for at least 12 months? That's where the focus was. But on the next slide, there was also another aspect of this, which was, and this also, just reminder where we are, this is the current requirement. So we haven't got to the new requirements yet. This is how it currently works. Is paragraph 73, which talks about if an entity expects or has the discretion to refinance or roll over an obligation for at least 12 months after the reporting date under an existing facility, it classifies that obligation as non-current, which basically means it's a variation of the right to defer. If you get to your year end and you've got a facility that could be rolled over in the next 12 months. So it might be due in the next 12 months, but it can be rolled over in the next 12 months. And that right exists in the hands of the entity. You can still do non-current, but there's actually a trick to this one. It's not only that you have the right to roll over as an entity, you also need to expect that you're going to actually use it. In other words, there's an intention element here. And those are the two aspects of this standard that got really exciting out in practice. Was what does it mean to have an unconditional right to defer, and what does it mean to have an intention to defer? And those are the two aspects that got the standard setter really excited, and they went on a journey. And this journey has been about 4 years. Aletta, I think almost as long as I've been at BDO, this has been on the agenda. So what Aletta has got up on the slide right now is our current guide to how to account for this. Now we're going to get on to what the changes are. So the changes, as I said, are encapsulated in a number of amendments that went through various stages of amendment. There were the 2020 amendments and the 2022 changes, but ultimately that has now been consolidated essentially into a sort of a 4-issue amendment. Now, the 4 issues that they've dealt with, which have led to the 2 sets of amendments, which will both be effective from 2024, are essentially your right to defer the settlement need not be unconditional and must exist at the end of the reporting period. So where you can see we're going is that word unconditional has been amended. In fact, you don't need an unconditional right anymore. But that doesn't mean you can do what you want. What they've actually just done is they've interpreted the conditionality a little bit better. We'll come to that in the next couple of slides. Second thing they've dealt with is the classification is based on the right to defer and not intention. So the 2 things I put on the agenda already is unconditional and the intention. Those are the 2 things they've changed substantially. There's been a massive amendments around what they mean, and there's a series of examples and interpretations that have been built into the standard to help everybody interpret this. So you can see already that this is going to have an impact. Almost exclusively already, if you base your current classification of current and non-current on your intention, if that is what you currently do, already there's a change coming for you, because intention isn't where we're going anymore. And then obviously, how do we interpret this unconditionality? We'll come to that soon. The other 2 issues, I don't want to say they're less important, but they may be a little bit easier to understand. The third one actually has to do with settling a liability with equity instruments. And so the big one here is convertible notes. When this standard was originally written, for presentation of current and non-current liability. It was authored from the point of view of a liability that would be repaid in, let's say, cash, or like a vanilla loan. It never really conceptualized the idea of settling liabilities with shares. So IFRS 9 and the financial instrument standards galloped ahead years ago on how to classify convertible notes and issues of equity instruments to settle liabilities. Those sorts of instruments can be liabilities, but the presentation of them wasn't really clear. This amendment has also dealt with those. So now we can actually get to a nice little answer of how do you classify liabilities that could be settled in equity or shares. So that's issue number 4. And then the fourth section is disclosures. Now, the disclosures we'll deal with later on. And so we'll just jump into the amendments as a start. Let's talk about the big change. And this is unconditional right to defer and the intention. We'll start with unconditional right. So first of all, it's become very clear now that in order to make the classification at the reporting date, you must have a right at the end of the reporting period to defer settlement for at least 12 months after the reporting period. That doesn't really change in much. It's the word unconditional that is being removed, but that doesn't mean you can just do what you want. What they've actually done is clarified how to interpret those conditions. And really what this boils down to is you must have the right to defer must have substance. In other words, it must be enforceable and exist at that balance sheet date. In many ways, they've actually made this about the legal rights, which weren't really clear before, and they've made it very clear that the right must exist at the balance sheet date and must have substance, in other words, be enforceable. So it's just brought it back to the legal side of it. That may not seem like such a big change, and maybe in practice, it probably is obvious to everybody that that's what they always meant, but they've just clarified it. But then they've gone further, and that's on the next slide, which is now how to interpret these conditions. And what they've done is introduced a paragraph 72B, and I'm pointing that paragraph out to you because I think you're going to find that in practice, most organizations are going to get very comfortable with that paragraph 72B. I want to say tattoo it on your forehead for the next 12 months because it's going to become, if this is the world you operate in and you have loans with covenants, for example, that paragraph is going to be really important to interpret this. And it basically boils down to this concept. Most organizations had difficulty interpreting the standard when it came to covenants because covenants aren't very neatly assessed at the end of a reporting period. Loan agreements are not drafted that way. And this is going to become especially important with green liabilities or green loans, and really anything that's got a covenant that a bank is going to assess. The standard never dealt with that. So people made their own rules up on how to interpret that. This paragraph is going to say, all right, if you've got a liability which must comply with covenants, and the covenants must be complied with before at the reporting date, then it does affect how you interpret your right to defer the settlement. And that makes sense because we'll see in a couple of examples, because if the covenants must be assessed at the reporting date, and it must be based on the numbers at the reporting date, then yes, it's going to affect the ability of, do you have a substantive right to defer for 12 months at that date? And that is true even if compliance is assessed after the reporting date. So if the covenants must be assessed on or before the reporting date, if the covenants exist at or before the reporting date, it does affect the assessment, even if they are assessed after the reporting date, for example, based on audited numbers at year end. Where you must comply with covenants after the reporting date, for example, if you have to comply with a working capital ratio in 6 months' time, then that does not affect your right to defer settlement assessment at the reporting date. And the best way to do this is, we've got some examples, because this, you can get all caught up in the language. So let's have a look at the examples. Now, I'm going to go through the examples slow enough, but it is something you should probably go back and look at again after this webinar to see if you're comfortable understanding this. We have a number of articles available on this on our website. We've done training on this in various forums around the country and also online. So there's a number of places you can go to, but let's start with these as our basic examples. We have an entity with a 31 December X2 year end, and they have a long-term bank loan payable in 5 years. Now, the bank can demand repayment immediately if a specified debt to equity ratio is not maintained at each year end. And I'm emphasizing that because those are the key words under the new rules. Because here what's happening is the covenant is actually assessed at the reporting date. It's based on audited financial statements signed in 31 March, in other words, in 3 months' time. The rule here, though, is even though we are assessing the covenant is met 3 months later, it is based on the numbers at the year end, at the reporting date. And so therefore, that is relevant to whether we have the right at the reporting date to defer settlement for 12 months. And you can see in the analysis here, if entity A meets the covenant at 31 December, even though it might be assessed on audited numbers 3 months later, it will be non-current liability if it's complied with that covenant test at the reporting date. So that's the first right to defer settlement. I think that's a relatively simple one to understand. It's probably clarifying something that a lot of us would have applied in practice already, but it does set the tone for what comes next. So let's jump to the next one and see how we go. So this one, example one, and by the way, the numbers of the examples 1A and so forth come out of BDO publications, and so you can actually find these in publications that we put out in a letter, and I've put that in at the end of the section. We've got links to those. So let's have a look at example one, and I want you to just kind of get comfortable with this one because there's going to be a few tricks and traps along the way. So yeah, we've got an entity B. It's got a 31 December year end. And by the way, you can apply this to 30 June as well. If you've got a year end, these are just examples. The loan is repayable in 5 years' time. So it's based on its repayment date, it's not current. However, it's subject to covenants. And those covenants are that the entity must maintain a working capital ratio as follows. At least at 1 at 31 December X1 and at least at 1.1 at 30 June X2. Now, what's important in the fact pattern here is that the date the covenants are assessed according to the loan agreement are not quite in sync with the reporting period. Well, it is for the first one, which is 1 at 31 December X1, but it must be at least 1.1 at 30 June X2. So let's have a look at what's currently happened. Sorry, go back a little. I just want to get the last part of the fact pattern. The last part of the fact pattern there is at 31 December X1, the reality was the working capital ratio is 1.05. So according to the test, it's met the at least 1 at December X1 covenant. It's met it. And management expects to comply with the 1.1 ratio at 30 June. Now, let's pause just a little bit. Think about what you think the answer is going to be. Has it met the 1.1 requirement that's required at 30 June X2? No, it hasn't. But that is a future covenant date and future covenant test, which it doesn't have to comply with. The one it must comply with for the assessment of the right at 31 December X1 is at least 1, and it has met that. But the fact that it hasn't yet met the one that's coming in the future isn't relevant to the assessment because it's down the track. So if we jump to the next slide with the answer on it, that's how we've assessed it. At 31 December, it doesn't need to meet the 30 June X2 covenant. It is only required to meet that one at 30 June X2, which is in the future after the reporting date. So that X2 covenant, 30 June X2, doesn't affect the assessment. The liability is classified as non-current because it's met the covenant that exists at the reporting date. That was not, sorry, Aletta, yeah?
No, you finish first.
No.
I'm just thinking, and I think a lot of people would say, but this is so obvious, right? At reporting date, I haven't met, how can I meet a covenant that is expected to come in 6 months because maybe my business is seasonal, and that's why I've got a higher covenant at the end of the year. And I think the difficulty here is in the past when we had this unconditionality for 12
That's
months, you know, some people argued, listen, I don't have an unconditional right for 12 months because I know in 6 months' time, I
I'm
might
not going
not
to
expect to meet the, yeah. So
That's
this
exactly
is
right.
actually a very useful amendment, and it actually clarifies it quite clearly,
And I
in
think,
my view.
Aletta, your point there is right. Even when I do these examples, they do my head in some days. And the reason why they do my head in is on one level, I think it's obvious. But you're right, that is not how it was interpreted before. What actually happened in practice is that the unconditional right became an absolute right for a lot of organizations and a lot of auditors in particular.
Yeah.
And that's the point that Aletta is making, is unconditional became absolute. In other words, you needed every right under every condition to avoid repayment in the next 12 months. And the fact that a covenant assessment was due in 6 months' time and you might not meet it, that became you might not meet it, therefore this has to be current. So Aletta is right. That example which I did, although it might seem obvious, a lot of organizations, or the one that's on the screen now, a lot of organizations would currently be using a current assessment there. And that means there's a change coming. So yes, let's have a look at another example. Now, lots of information on here as well, and one or two of the examples coming up I might skim over quickly, but I won't skim over this one. So example 2, Entity C, December X1 year end, 31 December X1 year end. Similar to the previous one, there's a repayment in 5 years' time. We've changed it slightly, and this is quite common in practice. The loan requires a working capital ratio of 1 at the end of each quarter. Just let that settle in. So every quarter period, including the 31 December X1 reporting period, will need to have a working capital ratio of 1. The loan becomes repayable if that ratio is not met at the measurement date. In other words, at the end of each quarter. Now we take a set of scenarios at 31 December X1. The working capital ratio is actually less than 1. So under the rules, the loan is actually repayable on demand. However, Entity C has obtained a waiver for the bank, and that waiver has been obtained prior to 31 December X1 in respect of that quarter's breach only. So although they haven't met the ratio requirement at 31 December X1, they've obtained a waiver. And that waiver was obtained prior to 31 December. Now that's important. The reason why that's important is because the right to defer must be substantive. In other words, it must be enforceable. Without the waiver being obtained prior to 31 December, it has no effect on the assessment. But in this case, because it's been obtained and it was obtained prior, at that date, there is a substantive right to defer, but only for that quarter's breach. At 31 December X1, sorry, let's go back, you jumped a little bit quicker. Entity C does not expect to meet the next quarter's working capital ratio of 1, being the 31 March X2 assessment. Now let that settle in, because what this is saying is this entity is actually not meeting its ratio assessment, and it's becoming a trend. And they've been given a waiver for the current 31 December X1, there's the current reporting period ends quarter breach, and they're unlikely to actually meet the ratio at the next measurement date. Now, I would guarantee to you that you would probably argue this is a current liability. And that's probably is true for the current accounting standards. But it might blow your socks off to realize that if we go to the next slide now, Aletta, that this would be a non-current assessment under the amended standards. Why? Because they have a substantive right to avoid settlement under the waiver at the balance sheet date, at the reporting date, and the next quarter assessment is actually in the future, and those are not relevant to the assessment of the deferral at the reporting date. And there you can see that the standard has a massive impact on the way you approach covenant assessments. That almost seems counterintuitive, but the intention of the standard is to actually bring consistency to the assessments and also to interpret what a substantive right at the balance sheet date actually means. But I will then put on the table that the disclosure requirements would be quite substantive here, because what you need to do at this point is disclose to the users that there is actually a risk that in another quarter's period, this is going to become due and payable. It's on demand, and that is essentially a business risk, and that feeds nicely into your OFR disclosures, which the letter is talking about under ASIC surveillance, because it's a business risk, and the users need to understand that although you're presenting it as non-current because you have a substantive right at balance sheet date to avoid settling this for the next 12 months, come 31 March, there's a real risk that you will be back in the same position that you were before you sought your waiver. That's a big example, and I'll let that settle in a little bit. Aletta, do you want to comment on anything at that point?
No, Kevin, I think this example, some people might say, you know, this is good news for me because my current liabilities are now becoming non-current. So I don't want us to stop here because the bad news is coming.
All right.
So in order to get a balanced perspective, let's put it that way.
All right. Jump into example 3. Similar scenario, December X1, entity D now, the loan repayable in 5 years' time. Same scenario as before, working capital ratio of 1 at the end of each quarter. The loan becomes repayable on demand if the ratio is not met at the measurement date. But in this case, at 31 December X1, the working capital ratio has been met. It's above 1. Is there a right that's enforceable for the bank to recall this loan at the balance sheet date? No, because the covenants have been met. Bank doesn't have the right to recall at that date, so a substantive right to avoid repaying does exist. However, subsequent to the reporting period, an event occurs that makes it highly unlikely that the 31 March quarterly assessment will be met. And the significant event is not within the control of a company. Let's say that there's an invasion of a country somewhere where the entity operates, and that's completely thrown the business model under the wagon, and so there's not much they can do to actually salvage the situation. In other words, they're heading towards a situation that at the next government assessment date on 31 March X2, they will have an on-demand liability. What do you think is going to happen? Yeah, well, jump to the answer, and Aletta can jump to the next slide. It's not actually that different to the previous one. The liability is still non-current. Why? Because the entity has met its covenants test at the reporting date. It has a substantive, therefore enforceable right to avoid repaying in the next 12 months because it's meeting all those conditions at the reporting date. However, disclosure, because there's a risk coming. It's essentially a non-adjusting presentation event, which will have to be disclosed. And in that case, the business risk is not only that the event has happened, but they actually can't avoid running into that come 31 March. This is the sort of disclosure that is actually going to require entities to say, well, what action am I taking to manage this? And maybe the action is I'm negotiating with the bank for a waiver or something like that. So even though the presentation is not changing, your disclosure, your OFR disclosure, and how you react into that business risk, your going concern assessment, it'll all come through in that sort of disclosure. And then off you go. All right. Hopefully everyone is hanging on to the desks, and this is going well in your mind. I'm just going to kind of pause at this point and just remind you that although not quite effective for 30 June 23 financials, it's clearly going to be effective next year, which means you may have to make disclosures in your financials about the impact of a standard not yet effective. And obviously you can see already that there might be some triggers here. You might actually have to make that disclosure. There might also be those of you who might want to early adopt in 30 June. And I would just say, seek some advice on that before running into that one. there was a point of time in the past where I was personally, maybe not a BDO approach, but I was personally not advising early adoption. But all of the amendments are out now, so that might be something you want to consider just to get it over with. But I would just recommend that if you're looking at that, just seek some advice, talk to myself or letter before running into it, and understand the business reason about what you want to do that for and what the impacts might be. Of early adoption. And one of them, for example, is early adopting a standard might have other consequences that you haven't thought through yet. And you just want to sort of tread cautiously there. All right, let's have a look at one of the other paragraphs. And this is just to kind of drive home the concept that intention is irrelevant. Currently, classifying a non-current asset if you have a rollover right, and this is paragraph 673, which I presented earlier, basically says if at the reporting period you have a liability that's going to fall due in the next 12 months, but you actually have a right to roll that over, and it is in your intention to do so, you would currently put that in as a non-current liability. All right. If we jump to the next slide, Aletta, and we'll come back to the disclosures as we move through this one's just demonstrating that concept of intention and how it applies under the amendments. So an entity C has a loan facility with the bank expiring 31 March X3. It's got a December year end. So the loan facility will essentially become due in the next 12 months, but entity C has a right to roll that loan over. In other words, it exists in the current loan agreement for another 12 months. The rollover is approved by the bank prior to 31 December X2. And entity C intends to repay the bank loan at 31 March. What would currently happen under the current standard is, because you have an intention to actually repay, even though you've got a right to roll over, bank has approved it, you've exercised it, the intention was to repay it, currently you would show that as current because you don't expect to roll over. Under the amendment, intention doesn't matter. So the fact that you have under the amendment, what's actually happening is you have a substantive right to avoid repaying. You've been granted that by the bank prior to the year end. So at the current reporting period, you have a substantive right to defer. And so under the amendment, even though you have an intention to repay, you must, under the amendment, put it into non-current. Why? Why have they done this? It seems completely counterintuitive. But the reason why they've done this is, one, to standardize the rules around non-current liabilities. But the other reason is because things change. They've actually they've made this amendment to align the standard with the other accounting standards out there. And the best example I can think of is redundancies and restructuring obligations. Under the provision standard, you do not recognize a provision for redundancies or restructurings unless you've actually committed to it and really can't get out of it. You don't provide for things that you haven't actually committed or haven't advertised or haven't told anybody about. And it's the same with intention. An intention may not be an intention come March anymore. So they don't want scenarios where you are presenting something as current because your intention was one way at December, but come March, things have changed so dramatically that you actually now lean into that right to rollover. They want consistency in the presentation based on the right and its substantiveness. And so this one is bringing everybody to, if you've got the right, even if your intention isn't to use it, the right exists and should be presented. And that's what they're heading to. And obviously there will be a whole bunch of disclosures that will flow from that. Now, in the interest of time, I'm going to speed things up because I suddenly realized we're a little bit over where we thought we would be at this point. And this is just changes in terms of the third issue that we spoke about, which was settling liabilities with equity instruments such as convertible notes. The rule really is, and there's a couple of paragraphs here, but I'll jump to the bottom, is if you've got a liability or a derivative liability and it's subject to a sort of a conversion feature that may actually allow early conversion into shares, the classification of current or non-current, you must consider that early conversion option. Previously, there was no guidance on this, so everybody was really just doing what they wanted to. Now, I think what I might do in the interest of time, if we just put the slide on there, let's see, is we won't jump into these all in detail, And I actually think I might ask you to go to example 4, just in the interest of the point we're trying to make, or example 3A, sorry, that one, is essentially example 3A. Sorry, Aletta, can you just jump back a slide?
Yes, I've got it.
This one here is entity D issues $1 million note payable. It's got an American style conversion option. In other words, that can be exercised at any time to convert and settle the loan into shares. If not, it's only repaid in 5 years' time. Now, in this particular example, it's a foreign currency note. In other words, the note is quoted in AD, but the functional currency of entity C is not AD. Now, we can get excited about that. And if you attend our later in the year webinar on convertible notes, we'll explain to you why this makes the note derivative financial liability. But ultimately, we've got a liability here being the obligation to repay in 5 years, but we've also got a conversion feature, which is the derivative viability, because it's a foreign currency derivative. And because of the rules involved under the new standard, it's very clear that because this can be converted at any time, that feature must be taken into account in the presentation classification of all the liability elements. And in this case, because it could happen at any time, it makes it current. That isn't so clear currently under the existing standard. A lot of people would currently classify that liability as non-current because it's only repayable in 5 years. But what the amendment says is, no, you've got an anytime conversion feature here. You must consider that in your classification. And because it could happen at any time and hence the liability could be settled at any time, you've got a current liability. That's what the amendment is saying, and that will actually affect a lot of organizations I know we've worked with in the past. Okay, Aletta, I will now jump through to you saying disclosures important, especially if you've got a non-current liability that's got a risk that you might have to pay it back depending on covenants in the next 12 months. There's a whole bunch of new disclosure obligations that come with that. And I think then, Aletta, I want to jump to the slide with the table just to kind of get to when this is effective, which is that one. These changes are effective for 30 June 2024, if you got a June year end, in other words, from 1 July 2023. But as I said, you might have to make disclosures about the impact of a standard not yet effective this year. And based on today's session, there's a lot of work there so you can actually get across what's going on and inform the business that this change is about to happen. All right, Aletta, I will hand over to you in the interest of time, because there's a lot we want to get through in, I think, 15 minutes.
So, Kevin, it's interesting. 30 June 2025 already starts to sound like a big date, because if you look at first-time application of these new classifications, which is a big change, especially if you have a lot of convertible notes. The date is 30 June 2025, and we know mandatory sustainability reporting IFRS S2 is 30 June 2025. So I think, you know how we talked about that second wave of IFRSs, IFRS 9, 15, 16? We're talking about a third wave of big changes coming our way in our financial reports and our annual reports. So there's a number of articles that you can consider, and we also have a publication with worked examples on these new disclosure requirements in IS1. And I really think commercially, practically, it would be good to know what this will look like in your financials in 2025 and onwards, if you enter into a covenant or a loan today. So just be aware of that. In the remainder of the time, and I know this is a special webinar where we've got 90 minutes, I would like to do a fairly fast flyover of a number of changes that's coming our way. If any of these are of particular interest to you, we've got articles you can look at, you can contact us, but we have some slides explaining them. So let's start. Standards applicable to 30 June 2023 annual reports for the first time. So we've got some amendments to Australian accounting standards, annual improvements, and for not-for-profits, amendments around illustrative examples for not-for-profits looking at AASB 15. The changes here, the annual improvements changes, you know, there's some changes to IFRS 1, first time adoption, IFRS 9, the 10% test for assessing whether a financial liability is new or the financial liability is modified. There's been some changes there. There's been a deletion of an example in IFRS 16, etc. The two big changes that we've talked about before is the one around onerous contracts. And I just want to put a spotlight on onerous contracts again, given supply chain challenges and the current economic environment, and that you've got locked in revenue arrangements, but not locked in cost arrangements. Onerous contracts, please be careful. And remember, we've changed the way we looked at onerous contracts, and in particular, the costs that have to be included in the assessment. So it's not just direct labor and material cost, but it is also incremental costs of fulfilling the contract. So it's direct labor, indirect and labor, but it's also the allocation of other costs that relate to fulfilling the contract. So it's an allocation of an appropriate part of depreciation on PP&E, etc. So it's a different way to look at the costs that have to be included in the assessment when you compare revenue and costs. It's not just direct labor and material costs. And then for PP&E, we also had a change around while we're busy with the construction of an asset, and there is some items that are manufactured on a test basis and we sell it, we no longer would take that selling price and reduce it from the cost of the item being constructed, but instead it would be a separate other income item. So again, that's a change that we've been talking about for a while, and there's some examples. If we look at half year, so if you're preparing 30 June half year, what would you be looking at? We've got insurance contracts. Most of this is around insurance. So remember, insurance contracts is not just aimed at insurance companies. Any organization that issue insurance contracts and assume assurance risk will be captured. So please look at that. And then the other standard is looking at, or other standards are around disclosure of accounting policies and how do we define accounting estimates. And we often run into that question, is something an error? Is it a change in accounting estimate? Is it a change in accounting policy? So there's some guidance on that. And then also a deferred tax related to assets and liability arising from a single transaction. Again, we've got some resources around insurance, significant resources around insurance, if you want to see whether you should apply IFRS 17 to some of your contracts. Again, if we look at accounting policies and estimates, as I say, in practice, it's often quite hard to assess whether it's a change in accounting policy, whether it's a change in accounting estimate. And therefore, we've had some amendments. And you know, they're talking about an accounting estimate. What is an accounting estimate? It's monetary amounts in financial statements that are subject to measurement uncertainty. So we've made an estimate, an accounting estimate of an amount, and the measurement of that amount, there's some uncertainty involved. So it could be expected credit losses in IFRS 9. It could be net realizable value in IAS 2. It could be fair value. It could be a depreciation expense. It's an amount again, and there's some uncertainty around how we measure that amount, or a provision for a warranty obligation, as a few examples, as accounting estimates. So really what they're saying, how do we develop an accounting estimate? We usually look at some kind of measurement technique and we combine it with inputs. So the inputs could be discount rates or cash flows, and the measurement technique, you know, there's an estimation technique around ECL or value in use, but there's also a valuation technique. You know, do we look at income approach, market approach to determine fair value? So an accounting estimate requires some kind of measurement technique, and it requires some inputs. So what's the difference between a change in accounting policy and a change in accounting estimate? Some examples. A change in accounting policy is you go from cost to a revaluation model on property, plant, and equipment, or if you change from capitalizing exploration expenditure to expensing it, or if you go from expensing short-term leases or low-value leases to actually capitalizing them under IFRS 16, which is allowed. So those are changes in policies. A change in estimate is if you change your depreciation right, or if you change going from straight line to reducing balance. And you change your depreciation right when you change expected useful life. Or if you look at inventory, if you go from first in, first out to weighted average, that is a change in estimate. Or if you change from using value in use to fair value less cost of disposal, when you look at recoverable amount, you use the higher of the two, but maybe you go from the one to the other. Then also, if you have a change in your expectation of mineral resources to be exploited, it's a change in your expectation there. Or if there's a change in lease term, it's a change in an estimate. All right, so you made an assessment or you made an estimate and now you're changing that estimate, which is very different to changing your policy. And then again, we've got some resources that you could consult on that. If we look at deferred tax related to assets liabilities in a single transaction, the best example here is actually leases under IFRS 16. You've got a single transaction that results in a right of use asset and a lease liability. And the question is, what do we do with those? Can we use the initial recognition exemption by looking at those two items together? And the answer is no. You look at the right of use asset and look at the tax base, and you look at the lease liability and you look at the tax base. You don't put them together and say, I use an initial recognition exemption. Again, we've got a publication dealing with that in particular, some additional resources. Standards issued, not yet effective. We know we have to disclose it, and IAS 1, as Kevin has flagged, we have to assess, especially if you've got a lot of convertible notes. It's going to have a big impact on your classification. Please look at that. But there's a number of standards around insurance, and there's a number of standards around public sector. There's also a number of other standards. The significant ones, there are two standards looking at current liabilities and how we classify the liabilities, but a number of other ones around accounting policies, around the deferred tax, which we've just talked about, etc. And again, they're not effective yet, but to make an assessment whether that will have a material impact on your business and your financials. So this one is around lease liabilities in a sale and leaseback scenario. And again, if you've got sales and leaseback transactions, to assess whether this has an impact on your business, and some articles. Recent IFRIC agenda decisions, and now we've talked about this over the years. If there's an IFRIC agenda decision, we have to implement this as soon as practicable. And the one that created a lot of heartache for us over the last 2 years was the SaaS implementation on configuration costs, where we had to do a lot of work in order to implement an IFRIC agenda decision. Now, there's been a number of decisions that we wanted to highlight. The one is around substitution rights in a lease. There's multi-currency groups in insurance contracts, if you're in that space. There's special purpose acquisition companies and accounting for warrants at acquisition. There's loan forgiveness of lease payments. There's negative low emission vehicle credits. There's a classification of public shares as debt or equity in special purpose acquisition companies. There's a little bit of a focus here on special purpose acquisition companies. There's transfer of insurance cover under a group of annuity contracts. And then if you're a software reseller, the principal and agent concept and how that applies. Now, in the interest of time, I'm not going to explore any of them in greater detail. We've got a number of corporate reporting insights articles that explore it. The substitution rights in a lease is an interesting one. It deals with batteries, electric buses. Please have a look at this one. Which is interesting here is if you've got a substitution right, you have to assess whether that substitution right is substantive. And it can only be substantive if there's a benefit for you for the supplier throughout the period of the lease. And in this instance, there's only a benefit that kicks in after 3 years. So there isn't a substantial and a substantive right throughout the period. So we've done a bit of an analysis. You can look at that. Also loan forgiveness of lease payments. Again, some discussion on whether we apply IFRS 9 or IFRS 16, and they've come out that you apply both, in that you look at IFRS 9 around the derecognition of an operating lease receivable, but you apply IFRS 16 when you look at the modification of future lease payments. So it's a little bit of a combination of IFRS 9 and IFRS 16. Kevin, if it's fine with you, I'm just going to move over this quickly. If we look at listed entities, there's some new reporting around oil and gas reporting, if you're in that space. And the reminder that we've got strict enforcement of lodgement deadlines. And remember, large private companies that's previously been grandfathered no longer have that exemption. Again, if you're an entity that have an AFS license, transitioning from special purpose to general purpose is happening. And we know there are requirements under Chapter 2M of the Corps Act, but also under Chapter 7 of the Corps Act. We've got a number of articles on how that flows through and what that could mean for you and what the potential mandatory transition dates are. Corporate bond rates, I think this is important. In the past, we've looked at Milliman, we looked at the G100 website to get the corporate bond rates as prepared by Milliman, and we never paid for this. However, now we're in a situation where we have to pay for these. BDO have to pay for these if we want to use it from an audit perspective, but clients themselves have to pay for this if they want to use it for preparation purposes. Hyperinflationary economies, we've had some adjustment to the entities or potential adjustment to entities that operate in a hyperinflationary economy. Sri Lanka, I would say, is on the watch list and expected to go into a hyperinflationary economy. And there's a bulletin that you can consult on that and a number of articles. With 3 minutes to spare, which has been a real marathon, and I've also tried to go very fast because my very naughty dog is looking for my attention outside the door. If you need any assistance, please reach out to any of our IFRS and corporate reporting leaders. We would love to speak to you and assist you. And then also our broader team would love to help you and assist you, whether it's lease accounting, whether it's getting ready for the auditors, audit ready, whether you're thinking about transactions and you would like us to help you with that, or whether it's sustainability reporting or even measuring your carbon footprint. Any of those, please feel free to reach out to us. Kevin, thank you very much for a marathon session.
Thank you, Aletta.
Doing 90 minutes, right? 60 minutes webinar. I'm not tired. 90 minutes, I'm exhausted.
And I think your dog wants to be fed. It's lunchtime, so
Yeah.
probably right. Just to everyone on the webinar, good luck out there for 30 June 23. It's almost a back to normal, but it's nothing but it's not like normal in previous years. It's a whole new normal. So good luck out there, and hopefully we chat to some of you along the way as you muddle through.
Thank you very much. Have a good day, everybody.